Welcome to 5 Barrel Factors, the channel where we break down the 5 key forces shaping global crude oil prices. During week 39 of 2025, Brent crude oil prices recorded a modest but notable increase. The benchmark rose by 2.4% week over week, climbing from $67.8 per barrel to $69.5 per barrel. Here are 5 key factors that influenced crude oil prices over the past week. First, tariffs and sanctions shockwave. At the UN General Assembly on September 23, President Donald Trump urged Europe to immediately stop buying Russian energy and adopt tariffs up to 50 to 100% on Chinese purchases of Russian crude. The EU has already pledged to phase out Russian oil and gas by January 1, 2028, but proposed moving up the LNG cutoff to January 1, 2027. Turkey, which imported about 330,000 barrels per day of Russian crude in 2024, is under growing U.S. pressure to halt flows entirely. Such policies tighten global supply, shift trade routes and raise transportation costs, increasing risk premiums. If implemented broadly, these measures would likely drive crude oil prices upward by constraining Russian exports and reducing available global supply. Second, inventory crunch in the U.S. U.S. crude stocks fell to 414.75 million barrels in the week ending September 19, the lowest level since January, while exports averaged 4.098 million barrels per day over the past 4 weeks, the highest since May. Imports surged to 6.495 million barrels per day, the strongest since August, but refining runs dropped to 16.647 million barrels per day after 5 consecutive weeks of decline. PADD3 stocks plunged 3.115 million barrels to 234.311 million. Low inventories combined with high exports signal tighter domestic availability, magnifying price sensitivity to supply disruptions. Falling inventories generally push prices higher because traders expect future scarcity and bid up crude in anticipation of tighter conditions. Third, Kazakh pipeline under fire. On September 24, a drone attack struck the Caspian Pipeline Consortium's regional office in Novorossiysk, injuring staff but leaving offshore loading buoys, which handle around 1.7 million barrels per day of CPC blend, operational. This pipeline transports Kazakhstan's landlocked crude across 1,500 kilometers to the Black Sea. Despite assurances from Kazakhstan's Energy Ministry of uninterrupted flows, markets remain wary of physical risk to one of the world's largest transit hubs for non-OPEC supply. Even without disruption, heightened security concerns add geopolitical risk premiums. Rising fears of transit vulnerability tend to support higher oil prices, even absent actual supply losses, due to increased insurance and shipping costs. Fourth, Russia's diesel clampdown. Russia extended its gasoline export ban through end 2025 and imposed partial diesel restrictions affecting small refiners under 1 metric ton per year, about 20,000 barrels per day. This move follows roughly 20 Ukrainian drone attacks in 3 months, reducing Russian crude runs by about 1 million barrels per day and lifting domestic fuel prices to record highs. While large refineries can still export diesel, the signal is clear: Moscow is ready to tighten controls on its most lucrative export stream. Any expansion of these curbs could squeeze European and Asian diesel markets. The tightening of Russia's fuel exports raises global diesel and crude benchmarks as refiners bid up feedstock to offset lost supply, generally boosting prices. Fifth, Kurdish oil returns to market. On September 25, Iraq's federal government and the Kurdistan regional government announced a historic deal to resume pipeline exports to Turkey after more than 2 years. Before suspension in March 2023, flows via the Kirkuk-Cyan pipeline averaged 230,000 barrels per day. 8 oil companies covering over 90% of Kurdish output agreed to the new framework under SOMO's marketing umbrella. This resumption injects new supply into a market already grappling with tight inventories and geopolitical risk. The return of Kurdish crude is likely to apply downward pressure on prices in the short term, as it adds barrels back to global supply and tempers the risk premium. Thank you for watching 5 Barrel Factors. Stay with us for clear, concise insights into the forces driving global energy markets. Don't forget to subscribe and continue following the channel for daily updates.